Hello and good day. I am Jed Wonderly, Certified Mortgage Planner with Noble Home Loans, and this is episode 3 of how to avoid the most common and costly mortgage mistakes. This is probably one of my favorite topics as a certified mortgage planner and somebody who was Series 7 licensed with Fidelity Investments back in the mid-90s. This is probably one of my favorite topics to talk about, and it is so key when talking about how do we structure your mortgage, especially if you're somebody who's got a bunch of cash sitting around and hey, I can make a huge down payment to make my mortgage payment as small as possible. This is an extremely fun and exciting topic because of how much wealth you can create if you do it right. Now, for those of you who may not have a lot of money for a big down payment, there's still a lot of great concepts in this video that's important to understand, so that when you get to your second or third home and you do have a lot of cash, you know what choice you should make, or at least you can make an educated choice and then make the one that's best for you. But there's definitely some great topics here for everybody who's buying a house, regardless of whether it's with an FHA with a minimum down payment or whether you've got, you can put 50% down and try to get your mortgage payment as small as possible. Some great stuff here, and we're going to start off with the time value of money. A couple of financial concepts we're going to talk about is time value of money and the rule of 72. Now, time value of money is the general principle is that a dollar today is worth more than a dollar tomorrow. Now, what we mean by that is that, and when we say tomorrow, we don't necessarily mean tomorrow, 24 hours from now. We mean, a year from now, 2 years, 5 years, 10 years, 30 years, whatever. But what we mean by that is that a dollar today is worth more because you can invest it. And when you grow that dollar, obviously it's going to be worth more down the road. Whereas if you don't invest it and you just sit on it, maybe in cash, or you're given a dollar, a year from now, or you start saving your dollars a year from now, well, dollars, because of appreciation, aren't worth as much a year from now. They don't buy as much. And when we talk about appreciation, we're talking about appreciation in prices on the goods you buy. We're talking about appreciation on investments. Apple stock not too long ago was basically a couple $100 a share. In fact, it was a lot less than that, just a few years ago. Recently, it got up to over $500 a share and then had a big split. Now it's down to about $90-something a share after that split. But that's just one quick example of how you can't buy nearly as much Apple stock today as you could have, a few years ago. Had you bought Apple stock a few years ago, or Google, or any other number of stocks, you would have a lot more money today because and part of appreciation. Now, one thing that that we talk about when we talk about appreciation is home prices. If you wait to buy a home till next year instead of this year, a 3 or 4% appreciation on a home. If you're buying a $200,000 home, now that home with a 4% appreciation is $208,000. You can't buy as much home, or if you do, it's going to cost you more. Because of the appreciation. Now let's look at Rule of 72. The Rule of 72 is a fantastic concept, and basically what it does is it's a great way to be able to calculate how fast your money is going to double based on your expected return on investment. So if you take 72 and you divide it by either your real return on investment or what you expect to get as a return on your investment, then you will get the number of years that it takes for your money to double. So for instance, let's say you take a $10,000 investment and you're going to get a 12% return on that investment, which many stocks and stock mutual funds can get on a number of years. Obviously sometimes they won't do that well, and some years there will be down years. But let's say we got a 12% return. We put 10,000 in. 72 divided by 12 is 6. So that means that if we got a 12% return on our investment every year for 6 years, our $10,000 would be $20,000. Actually, just a little bit more than $20,000. So if we took that same $10,000 and got an 8% return, then 72 divided by 8 is 9. So now it would take 9 years instead of 6 years to get to double our money. So that's basically how the Rule of 72 works. Now, where that comes in, I've had some clients recently and they've had large amounts of money to put down. Let's say $150,000 to put down, and let's say they're going to buy a $300,000 house. Now, if they put $150,000 down on a $300,000 house, that's 50% of the purchase price. They're going to have a relatively small mortgage payment. They really, if they want to avoid mortgage insurance, they really only need to put down 20%, which on a $300,000 house is $60,000. Now that leaves them $90,000 to invest. So let's show you the difference between that. If you put $150,000 down, you got a nice small mortgage payment, and you're off and running. Well, you could take the savings in your mortgage payment from what you would save versus the higher payment at a $240,000 mortgage, and you can say, okay, I'm going to save that and invest that every month for the term of my mortgage for 30 years. And you would amass a nice chunk of money. But on the flip side, if you were to take that $90,000 right now that you're not putting into your mortgage, and $90,000 ends up becoming on an 8% investment in 9 years. Let's say you're 30 years old, and in 9 years from now, let's even say you're 35. In 9 years from now, at age 44, that $90,000 is $180,000. 9 years from then, at age 53, that's $360. At age 62, that's $720, and at age 71, that $90,000 without putting another dime in it is $1,440,000. That's huge, and that's because you structured your mortgage properly. And you might not even need that payment savings, because with $90,000 invested now, what are you doing with that payment savings? You're making the payment. That person might have committed to making that full payment as he would have based on a $240,000 loan. He's just going to make a payment on $150,000 to his mortgage company and then the rest to his investment company. Well, if you're going to make that payment anyway, why not be more liquid right up front? That's another huge key, and that's for another topic. But if he kept the $90,000 out, he's more liquid to start with. He's jump-started his investment, his or her investment, and now he's got a lot more money working for him a lot sooner. And that's where the time value of money comes in. $1 today is worth more than $1 tomorrow. So it all ties together. It's very interrelated. And that's why I highly recommend that people that have this huge down payment don't tie that money up, one, into the illiquid asset, and two, into an asset that's going to appreciate regardless of how much money you have down into it. For instance, if homes in your local area are going to appreciate at, let's say, 3% per year or 4% per year, then it's not going to matter how much money you put into it. You're not going to get a bigger return. In fact, because of leverage, you're actually going to get a smaller return by putting a bigger down payment into it. So that's one key factor. Let's look at another factor. Take another situation where somebody wants to do some tax planning with regard to their retirement, and so they want to invest in a Roth IRA. Roth IRA allows you to invest without any tax advantages up front, but when you pull the money out when you're retired, you get after the age of 59 and a half, preferably all the way up to, don't start it until you're 70, but the money you pull out is tax-free. So hopefully that can grow and grow and grow for you, and you're pulling out all this tax-free money, which is great, because heaven knows that taxes are likely to go up with the kind of debt our country is in, which is why tax planning is very, very important. But now, so let's take somebody who wants to contribute to their Roth IRA. If you put $11,000, that's $5,500 for yourself and $5,500 for your wife, and that's the maximum you can contribute at this point in time. If you put $11,000, again at that 8% return, if you start that off when you're 25, again, time value of money says the sooner you start it, the better. If you do that at age 25, then at age 34, that $11,000 that you're putting in for you and your wife is now $22,000. At age 42, it's now age 43, it's now $44,000. At age 52, it's now $88,000. At age 61, it's now $176,000, and it's $352,000 at age 70. And that's just contributing for 1 year. I would certainly recommend to invest that $11,000 every year, because you get to take advantage of dollar cost averaging, which is again another topic that we can talk about. feel free to call me at 702-812-1214. That's 702-812-1214, and I'd be happy to talk about all of these concepts that we're talking about and explain them further, recommend you to some great financial professionals, and I'd love to help you do your loan. That is, of course, my area of expertise and what I do and how I make a living. But the key point to take away from all of this, and this is absolutely huge, if you don't get anything else out of this video, pay attention right here. Because the key point with the Rule of 72 and the time value of money is getting started early. Because remember, that $11,000, that one-time investment of $11,000 at 25 became $352,000 at age 70. That $90,000 investment for a 35-year-old became $1,440,000 at age of, I believe it was 70 or 71. But here's where this is very, very important. You need to really pay attention. If you hold off one doubling period, so that's 9 years. If you said, you know what, I'm gonna buy a few things that I really want right now. I want to get a boat. I want to get an RV. I want to go on vacations around the world and that kind of thing. I will start investing a few years from now. Well, if you put that off one doubling period, instead of having $352,000, you'll only have $176,000. Instead of having that, you know, and of course on the $90,000 one, that's a little different because that was a one lump sum of money that they had from the sale of another home. So if they spent that, they may not even have $90,000 9 years from now to invest. But let's say they just said, you know what, I'm going to hold off investing right now. I'm gonna, you know, just put it in cash, put it under my pillow. Don't want to invest until 9 years. If they did that, they'd have $720,000 instead of $1,440,000 for missing one doubling period. I highly recommend taking advantage of the time value of money and the Rule of 72 and using them to your advantage. Use leverage. Allow the bank to, especially with the rates that we have now, to finance as much as possible that makes sense for you for a payment that you can be comfortable with, but also remembering that you don't want to buy that payment down. One, it's very expensive, and that's, again, something that we can talk about and we can go over the numbers in person. There's ways to get payments lower, and it's not usually by putting a bigger down payment down. And sometimes there's certain cutoff points. But the main thing is that how do you want your financial future to look? And how it's going to look is going to be very dependent upon the kind of decisions you make with the largest asset purchase of your life, in most cases, which is your home, and how you finance that. So I would hope that you would call me, Jed Wonderly, Certified Mortgage Planner with Noble Home Loans at 702-812-1214. I know I went over my 5-minute time period again. I apologize, but this is something I'm very passionate about. Love talking about this because I love helping people understand that they can really prepare for retirement, that it's not a hopeless case, that they can certainly amass a fair amount of wealth so that they can live out their dreams and be very comfortable in retirement. So again, my number 702-812-1214. Call me and let's talk about how we can maximize your situation in terms of getting you the right mortgage and having some money left over either at the end of the month or at the end of your down payment so that you can get that invested and get that working for you. Thank you for watching. Please like, comment, and share, and subscribe to my channel so that you can get the rest of my videos as they come out. And I look forward to talking to you, I hope, and hope I get to help you someday. Take care and have a great one. Bye-bye.